If October ends up being a bullish month for the S&P 500, that would make 6 straight months in a row where we have nothing but upside. Bullishness, it feels like almost every single day. Of course, we had the April sell-off where stocks really went south real quick, but we bounced back just as quick post-Liberation Day and have essentially rebounded and taken over those highs decisively. This is a classic bull market move, and these drifts to the upside are actually not that uncommon when we take a look at the last 20 years in the stock market. You've really had several periods like this where you can have this kind of upward drift even on a monthly basis with very little pullbacks. That being said, with such a stretch, is it reasonable for the stock market to keep going like this? Well, sure, it could with momentum on its side, but I also think it's perfectly normal that we could get a pullback in stocks. Now, I'm not trying to time this or call that pullback, but I did mark up my fibs from the lows of this move in April up to where we currently sit at our highs. And we see something kind of interesting take place. The prior all-time highs before all this craziness following the tariff stuff, we did see kind of this area around 600 on the SPY. And it's actually not out of the question that even in a healthy bull market, you could get a pullback of this nature. That's just, by the way, around a 10 to 11% pullback, a very normal and actually common thing every, year and a half or so, I believe, is the average where you get some 10% pullback in the stock market. So is it possible? Sure. What could be the catalyst? I don't really know. Right now, seems very strong out there for the stock market. And specifically what I'm talking about is the macro. Let's take a look at the macro screener here to give us an outlook. What we can see is the Edge Finder or the stock box, if you're familiar with either product. We use these tools at A1 Trading to scan a lot of macro data, but the stock box specifically is built for analyzing stocks and ETFs. And what we can see here is that overall our stocks impact score is pretty high. What that means is that a lot of our growth metrics, for example, you can see a lot of these things getting bullish impact scores here, specifically things like manufacturing PMIs, GDP growth, retail sales numbers. And what this is doing is it's comparing the forecasted data for these commonly referred to like non-farm payrolls, et cetera. And it's giving us an actual comparison showing the surprise metric here and giving us an overall view of the macro economy. Right now, it looks pretty opportunistic for stocks. And so I'm not necessarily thinking that we do get some sort of pullback. In fact, I actually think that pullbacks in the stock market right now are likely to be aggressively bought. And so when we zoom in a little bit from that monthly chart view and start taking a look at the daily chart, I actually think that we could see buyers come in as aggressively or as quickly around the 655 mark. I don't necessarily think you even have to go all the way back down to 600, and that we could continue to see stocks sort of melt up like this into year end. In fact, if we take a look at seasonality, that is something that we actually see. Check this out. So I'm looking at the annual full year seasonality of the S&P 500, a good barometer of the overall performance of the stock market. The white dashed line is the historical 10-year average performance of the stock market. And the red line is this year so far. Now, what you'll notice is that for the most part, we have kind of followed suit. We had the dip here early portions of the year. And if we take a look at where we currently sit, things have sort of defied the trend where we typically see some sort of pullback, some sort of softness in market performance. We have not actually seen that in September. And so far in October, we're actually starting off on a strong note. But when we start looking at the end of the year, there is a seasonal tendency for stocks to actually perform very strongly. And I think this is really interesting for us to keep our eye on, because as we enter into this period, this is where I'm saying you may not get a sharp pullback in stocks, and that in fact, even minor dips could be aggressively bought as you get the year-end chase for performance. Now, of course, the idea here is not just to look at the SPY, but also to start getting into some sectors. And I want to actually show you that with our macro screener. What we can see here is down at the bottom section here, we have sectors that are getting stronger macro scores and sectors that are getting weaker macro scores. And I find this to be useful because now we can take a look at some of these ETFs and ask ourselves if maybe there are some better opportunities in particular parts of the market. So I'm going to close out our seasonality. I thought that was really worth sharing here today. But let's take a look specifically at the XLY. And the reason I'm doing that is because we were getting a strong score here for consumer discretionary stocks. These are your stocks like Nike and Amazon and Tesla. And what we actually can kind of see here is that they've had a nice rebound from the April lows, but they got hit hard off the idea that tariffs could cause inflation, which could push back on rate cuts. And now, with things looking more opportunistic with rate cuts on the horizon, we actually see consumer discretionary stocks doing quite well. And so when we mark up our charts here, I'm going to apply a simple RSI to the screen here. We can start to see we're getting close to a bit of an oversold reading. If I'm taking a look at the support and resistance areas that I see on this chart, you have some pretty clear area where we saw some bounce back to those highs for around the 235.50 level, which is pretty close to current levels. I think that you could see, if you do see a pullback into these areas this week, you could see some response from the bulls around this area. If the stock market is just going to continue to push up into year's end, I do actually like the consumer discretionary area off the idea that the economy seems to be holding up, you have growth out there, and rate cuts still seem behind or on the way. So if I'm taking a look at this, how could I map out a trade? Well, one idea would be a push down to this 235.50 level with a stop loss below this area of support that we have looking left, perhaps a stop loss around like the 231 mark, and looking for, again, expansion of price to the upside. So I actually like consumer discretionary stocks. And now what we could do here with this consumer discretionary idea is we could either trade the ETF, which I like the trade there, or we could actually take a look at some individual stocks within the stock box that are getting maybe some stronger scores here. So what I can do is go to the top stocks algorithm, which looks at technical readings, sentiment readings, and financial readings like PE ratios, price to sales, revenue growth, earning growth for all these different stocks in our system. So if I take a look at the sector, what do we say? We wanted to look at consumer cyclical, right? What we can see is we start to get an interesting couple stocks that stand out with higher scores than the rest. Amazon being one of them. Let's take a look at AMZN, see if we can find anything within, again, the consumer discretionary. Now, I own shares of Amazon. I've owned it for a little while. I've actually bought it during the April sell-off. This is a stock that I like and have liked it for a long period of time. But I am potentially willing to maybe look into adding some more shares to my portfolio. So an area that is really obvious to me with Amazon, which would probably follow suit if you also saw XLY move lower, would be a pullback into the 212 level. And I've been eyeing this level for a little while. We paused here in the summer months, found support here also in the August sell-off that we saw here in Amazon, and bounced back. So actually, if we do get a push down into this area, this to me looks like an attractive entry point to add some shares to my Amazon position. So I'm watching Amazon here for a pullback into 211, 210, 212, this area in the upcoming week. So that's going to do it for the consumer discretionary side. Let's keep going and go back to our macro screener. I love using macros, kind of my core basis. I'm what many would call like more of a top-down stock market analyst. So I'm looking at the macro and the overall Federal Reserve and what the economy is looking like. And then I'm picking individual stocks that fall into sectors and areas that I think the economy supports the most. And again, it sounds simple, but it's really reliant on having the right tools. By the way, the tool that I'm using, if you want to explore Stockbox, there's a link in the description down below. And if you're interested in exploring the stock box and the full list of features that are offered, check out that link in the description to also take advantage of the 30-day trial that we offer to our users. The stock box is a great tool for those looking to analyze stocks with the proper tools to actually find things not just based on technicals. Many technical screeners out there exist. But what's cool about the stock box is it actually helps you to look across the macro, the financials of stocks and companies, the overall economy, etc. So anyways, I want to keep going with this concept. Also, the Russell 2000. Let's take a look at IWM. Of course, that is the sector, or not the sector, but the index, right, reflected in an ETF. So the Russell is a collection of small cap stocks. I also like this one on a pullback. Interesting candle there on Friday, a little bit of rejection here as we tapped into the highs. So if we do see some pullback here, I'd be probably a buyer around the 236 level, let's call it, on the IWM. Let's keep it moving because we got a lot to look at here today. Industrials also getting a high score within the Edge Finder. The stock box. I get these two things mixed up because I offer two different products. One's more for stocks and options and ETFs, and the other is more for futures and commodities and etc. Anyways, XLI, this is the industrials sector. And interestingly, guys, it looks like we are on the cusp of a potential breakout here in the industrials around that 155 mark. If you do see a breakaway movement here, a little bit of a cup and handle, whatever you want to call it, formation, but really you just have this resistance. We've consolidated here, call it a bull flag, call it whatever you want. It looks bullish. And so to me, the upside here still looks really good for industrial stocks, especially if you're going to get, this AI build out demands a lot of power. It demands a lot of grid build out, a lot of construction, these data centers. So to me, industrials is an area of the market I like quite a bit. So we can actually take a look at some individual industrial stocks. Let's keep going with our procedure, and you're going to see it's very repetitive. Let's go to our top stocks, and now let's look for not just XLI, which is the whole thing, but maybe we can find some stocks within the sector that we like the most. FDX. Let's take a look at FedEx really quick, getting the highest score. Now, what this means, by the way, guys, let me just break this down. Momentum, overextension, institutional activity, analyst ratings, PE ratios, price to sales, revenue growth, earnings growth, debt to equity, return on equity, price to free cash flow, and dividend yield. Those are all the metrics that our system is automatically watching for you when it comes to individual stocks to potentially look into. So FDX, can I find a trade on FDX? Well, FedEx has a little bit of an interesting pattern forming. You have some key resistance here. You have multi-month levels of resistance here around this $245 a share, and the stock looks like it may want to break out here. So this could actually look like similar to XLI, a possible breakout type formation. A pullback into this area could be really attractive. I actually like the possible breakout trade here on FedEx. So we can also take a look at UNP. Let's take a look at UNP, of course, Union Pacific Corporation. Interesting similar chart here. I do like the tap into resistance. You guys know, if you've been watching my channel here, this is one of my classic favorite things to look for, is look for a key area of resistance on the chart and watch for the break. That break can be like a dam breaking, right? It's like all the when the levee breaks, right? So if all the flood water comes rushing through once you get that breakout, and then you oftentimes get that dip, that pullback into areas of support. So I like this quite a bit. I like Union Pacific. I like FedEx. Both look like possible trades. Probably going to skip on the rest just because they have a little bit lower scores here. But we can go back and again, repeat the process. This is how essentially I do my trading when it comes to stocks. XLK, okay, technology stocks getting some strong scores here. What technology stocks? I mean, there's a million tech stocks that everyone knows and loves. Tech stocks are also in a roaring upward trend here with a lot of momentum. I would love to see if we could get a pullback on this one. I like the 61.8% retracement on this Fibonacci level. Looking at tech stocks, XLK. One thing I would caution you on, though, and this is why I wait for dips specifically to potentially take on a trade. And even if I did take a trade, let me explain why a stop loss would be really important on XLK or any individual tech stocks that I'm looking to trade actively. The reason for that is because tech stocks are expensive. Let me show you. If we take a look at the historical PE ratio, specifically for XLK, another tool that we have within the stock box, what we can see here is that right now we are in the 90th percentile of expensive PE ratios, historically speaking, for tech stocks. Tech stocks haven't been this expensive since, you know it, the dot-com era. We know how that ended. So I'm really cautious with tech stocks and with just stocks in general. I'm not looking to pile in and invest super long-term at this moment. I actually think that the thing to do right now, this is my opinion, not financial advice. You do what you want. You should probably ignore everything I say. I'm just a trader on the internet. My opinion, I think tech stocks and all these things are going to have some sort of correction in the coming, months or years. And what that leads me to believe is that the better spot for me to be in is trades with stops, managed risk, diversified, but not parking all my eggs in one basket, which is the popular thing to do right now, by the way. The popular thing right now is to be long semiconductors, right? Semiconductors are doing phenomenal. Technology stocks doing phenomenal. US tech stocks, that is the place to be. But my concern is what I just got done showing you. They're expensive. And the reason that this is, historically speaking, just something to be cautious about, not necessarily to be, overtly, shorting the market or anything. I'm not doing that at all. But the reason to be cautious is that, historically speaking, when stocks get really expensive, what that really equates to, what it means, is that people's expectations for stocks are really, really high. And when everybody's expectations are very high, it's very easy to displease investors. And when investors are displeased, what do? They sell aggressively. And so I think, again, big picture, I'm not trying to sound like a bear or an alarmist because I'm not short the market, but I am cautious and I'm still sitting on some cash waiting for what I believe could come in the form of bigger dips. There's a couple things that could potentially trigger this, but I'm not going to try and call them. For example, maybe the Fed pauses rates and doesn't stop and pauses the process of cutting interest rates. Maybe something flares up with tariffs. Maybe oil prices spike. Maybe something happens with Russia. I don't know. I'm not trying to make a prediction that I think the stock market is going to crash. But what I do know is that expectations are high. And if something comes along that disrupts the peace, we could very quickly see a correction in the market. And so I'm keeping some cash on the sidelines. I'm still trading long on many different individual stocks. In fact, take a look at my portfolio. Here is a bunch of stocks that I am in, either trades or some that I've invested in. Like Meta, I bought in the April sell-off, right? I'm doing just fine on Meta. But if I take a look at some other names like Uber, I also bought during the April sell-off and even before that. So I have several names that, I bought them when people were terrified and the expectations on these stocks were very low. But now expectations are very high on stocks. And so I'm a little bit cautious. Here's, for example, a trade that I have. So I've got a lot of trades that I'm doing, but I don't have a lot of stuff where I'm parking long-term investment capital on my personal portfolio. Again, I like BIIB. This is actually one of the top stocks page listed stocks. So if I just reset this page, you'll see that BIIB, this is Biogen, getting a +9 score, positive momentum and institutional buying. Analyst rating is strong overall across the analyst lexicon, and the financial readings still look good. Everything kind of aligned for me on BIIB. We pulled back into an area of support, this upward trend line, and we were getting even touch of the just a cherry on top, a bit of an oversold reading in combination with the financials and everything else. So I went long the stock with my stop loss initially below, and I have now trailed my stop loss into profit below structure here. So I'm managing many trades and just kind of trailing stops and trying not to play too much musical chairs with the market itself. Because again, I do think that it's due for a bit of pullbacks. Again, if we take a look at like QQQ, we've had just a phenomenal run up. And typically, even in bull markets, like you can still be bullish and also say, look, in bull markets, you still get waves, even in bull markets. So to me, you just logically, maybe it's perfectly fine to take a little bit off the table, which is what I have chosen to do over the last 2 months. Now, admittedly, I've been a little bit early to this idea of thinking there could be a pullback coming. And you could argue this was a bit of a pullback, but I think more of a pullback being on the S&P 500 and the NASDAQ, specifically the NASDAQ being somewhere between 5 to 10%, being a perfectly normal dip, at which point I would be looking to buy some of the names that I like more than others. So just wanted to share that. Again, I know it's not the popular thing. I mean, these days you go out and you say, hey, I think the market may be a little stretched. You get stoned on financial Twitter or wherever you go, right? People are super bullish and nobody wants to be, caught being called a bear. And I am not, like, I want to clarify, right? I don't want to be called a bear either because I'm not a bear. I mean, I literally look at my positions and I don't have any shorts, right? I'm only long the market. So I'm not bearish either, but I do think you could make the argument that because I'm taking some stocks and taking profits off the table, that you would call that a little bit more cautious. I wouldn't call it bearish, but definitely more cautious than perhaps the average, guy on Wall Street, I suppose. Again, I could be wrong. I've already been a little bit wrong in the terms of timing this top, but I'm not really trying to time the top. I'm just freeing up some cash for what I believe could be a dip in markets. We may get it tomorrow. We may get it 2 months from now. We may not get it at all. But my opinion is I think stocks would be a little bit more attractive. The risk reward would be better if you got some dips. And if you don't get it, then you don't get it. Some other stocks that I am watching is ABT and UNH. Let's take a look at these really quick. ABT, if I pull this one up, Abbott Laboratories. I kind of missed my entry here. We had this level marked up and we just barely tapped into this area before bouncing right back. So I'm still watching this area. If you do come back and give me that second chance, I may get into the stock there. If we take a look at UNH, I played some short put positions on UNH earlier this year. I did pretty well on those, but I am now looking to just buy the stock if you were to get a pullback into this 38.2% retracement around the $320 per share mark. I think you may have actually bottomed out on UNH. And we'll see. I mean, because there's been a couple times where people have thought that, and then, of course, the stock rolls over again. But I think that UNH, personally, I believe it is an oversold and undervalued stock. If I take a look at the stock analyzer to take a closer look at UNH, we can see a lot of our financial metrics here within the stock box are showing some pretty good metrics. Like, for example, we're getting a trailing 12-month PE ratio for UNH that's at 15.59. That is significantly lower than the historical average. We still have revenue growth. Earnings growth has been under, stress, but I think we could rebound on that front. And if we take a look at price to sales, if we look to debt to equity, I mean, the stock looks cheaper than usual, and yet the stock has gotten killed. So to me, it's like, okay, we look at that and we say, okay, that might actually be an opportunity to step in and buy this if we do get a dip. And yes, we've had a big run up here, but remember, we are still talking about a stock that has gotten cratered. Yes, you're 55% off the lows, but off the highs, you are also still a significantly down 42% from the highs. So, this stock, in my opinion, has plenty of room. Let's just say I get what I want here. Price pulls back to this 315 level, and I could get in on the long side. I could double my money if the stock were to make a continuation back to those highs. And I don't think it's necessarily going to go straight there, but I do like the risk reward to the stock. So we also saw, interestingly, on UNH, a lot of institutional buying that took place in the previous quarter in the 13F filings for a lot of institutions. I believe Warren Buffett, or maybe not Warren Buffett, but I know maybe he did. Somebody let me know in the comment section. I believe he did, but we could pull it up in the software, but I'm just rambling here. But I think actually UNH has been bought by many different institutional investors in the previous quarter. So we'll see if that can continue to drive the stock higher. Volatility index still very, very low. I do have, let me just full transparency, although I am not short the market, I do have some long calls, just some small positions as hedges in case we do see a sharp market sell-off. The VIX usually will pop in that circumstance. So I guess you could make the argument that I am a little bit on the bearish positioning side as a bit of a hedge to the market. But again, I have those calls going out to the end of the year. So they are not necessarily like it's got to roll over tomorrow. They could, it could happen in 2 weeks or 3 weeks. We could see a little bit of a pullback and I could potentially make some profits off of those fixed calls that I've got in the portfolio. Let's see, what else do I have? Any other positions? I have the dollar. This is something I talk more about on my other channel. I am long the US dollar. I think this actually could be another catalyst if you were to see a market correction, would be a sharp rise in the US dollar, which would probably coincide with rate cuts being taken off the table. So we'll see. But I talk more about that, like I said, on my other main channel if you're interested in exploring my thought process with the US dollar. And if we take a look, what else do we have? PayPal, Amazon. I also have some trades on like NEE, so utility stocks have treated me well here. I trailed my stop loss up to 76.16 on this one. And we also have XEL, another utility stock. I've done pretty well with this one. Actually, this is one of my favorite utility stocks that I have traded many times in and out of in the last I guess 10 years almost since I started looking at stocks. But for me, XEL, I've trailed stops here. If we fail at the 38.2, I'm just going to take a profit. But I do think we have potential for utility stocks to continue to drive higher. If this AI hype stuff still keeps going, utilities are a place I think benefits, right? Because you have huge demand for power, and power companies can kind of be the picks and shovels to the picks and shovels businesses, the chip manufacturers for the data centers, right? For the AI trade. So it's like, picks and shovels for the picks and shovels companies, if that makes any sense. But anyways, that's kind of what I'm looking at. I hope you guys I hope you found this useful. And if you did, consider subscribing to the channel, hitting that thumbs up button. Remember, if you want to explore the stock box, I'll leave links in the description down below to where you can find out more information. Thanks very much for watching, guys. Have a great week ahead.